Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cnx Resources Corporation Annual Report. Cnx Resources Corporation is a leading independent natural gas and midstream company that operates in the Appalachian Basin. The company's primary business involves acquiring, exploring, developing, and producing natural gas properties across various states. The company's services can be broadly categorized into several key areas. Firstly, it engages in the production and sale of pipeline-quality natural gas to gas wholesalers. This is achieved through its operations in two main segments: shale and coalbed methane (CBM). In addition to gas production, Cnx Resources also owns rights to extract natural gas from various shale properties across Pennsylvania, West Virginia, Ohio, Illinois, Indiana, New York, and Virginia. The company's midstream segment is equally significant, with a focus on designing, building, and operating natural gas gathering systems. This involves constructing approximately 270 miles of natural gas gathering pipelines, as well as various natural gas processing facilities. Furthermore, Cnx Resources offers turnkey solutions for water sourcing, delivery, and disposal for its own operations and those of third-party clients. In summary, the company's business portfolio encompasses a range of services including natural gas production, midstream operations, and water management solutions. The stock price of Cnx Resources Corp. has increased significantly over the past year, with a notable rise of 31.94%. Several key events have contributed to this positive performance, including strong financial results for the fourth quarter of 2025 and an expanded share buyback program. The company's acquisition of Apex Energy, II's upstream and midstream assets, also played a crucial role in expanding its operational footprint and increasing proved reserves. Cnx management's emphasis on operational discipline, proactive hedging strategy, and commitment to low carbon intensity natural gas production have further boosted investor confidence. Additionally, the company's share repurchase program has been aggressive, with a significant expansion of the buyback program to $4.45 billion. These factors combined have led to an increase in stock price, outperforming many industry peers and the market as a whole. The acquisition of Apex Energy II's assets nearly doubled Cnx's PV-10 pre-tax discounted future net cash flows to $6.83 billion, reinforcing operational control and planning visibility. The company's proactive hedging strategy has also ensured balance sheet strength and predictable cash flows amidst market volatility. Overall, the combination of strong financial results, strategic acquisitions, and management's commitment to sustainability have driven Cnx Resources Corp's stock price increase over the past year. Cnx Resources Corporation market capitalization of $6 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Cnx Resources Corporation holds a significant advantage in their industry. Cnx Resources Corporation trades at a higher price-to-earnings ratio of 10 times and a higher price-to-book ratio of 1.29 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 52% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has aggressively reduced its share count despite weak revenue growth. This raises concerns about whether buybacks are being used to offset underlying business challenges. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of the provided data. In terms of segment performance, the shale segment experienced a significant increase in revenue, while the cold methane segment saw a decline. The other segment also showed growth. A closer examination of the key drivers reveals that decreases in natural gas, NGLs, and oil revenue were major contributors to the decline in revenue for both the shale and cold segments. Additionally, a decrease in gain on commodity derivative instruments further exacerbated this trend. On the other hand, an increase in total segment revenue from contracts with external customers was a significant driver of growth in 2025. This was accompanied by an increase in the total average sales price, including effects of commodity derivative financial settlements, and a decrease in purchased gas costs. Furthermore, extensions and discoveries, as well as price changes, also played a crucial role in driving revenue growth or decline. The company's ability to purchase reserves in place and increase production levels were other key factors that influenced its revenue performance. Overall, the data suggests that revenue growth or decline is driven by a combination of factors, including segment performance, key drivers such as natural gas, NGLs, and oil revenue, and external market conditions. The net income of the company underwent significant fluctuations between 2024 and 2025. Initially, it decreased by $12 million, or 9.5% from 2024 to 2025, but then increased by $724 million in the same period. This change can be attributed to various factors, including changes in tax laws and rates, as well as uncertain tax positions and state taxes. Profit margins also experienced a mixed trend during this period. While the company's overall profit margin improved due to an unrealized gain on commodity derivative instruments, certain segments such as shale, cold methane, and others saw significant decreases in their profit margins. However, the natural gas, NGL, and oil production margin increased by 29% from 2024 to 2025. The reasons behind these changes are not explicitly stated in the provided text, but it can be inferred that the company's improved profitability is due to changes in revenue or cost structure. The significant increase in net income from a loss in 2024 to a profit in 2025 suggests that the company has made substantial improvements in its financial performance. The company's financial performance indicates a steady increase in its ability to generate cash from its core operations. The operating cash flow has shown an upward trend over the past 2 years, with a notable jump of $191,108 from 2024 to 2025. This positive growth suggests that the company is efficiently managing its resources and generating sufficient revenue to cover its operational expenses. As a result, the company is able to produce a surplus in cash flow, which can be utilized for various business purposes such as investments, debt repayment, or further expansion. Overall, this trend indicates a healthy financial position for the company. The company's debt level has undergone significant changes over the past year. Initially, it was noted that the debt level had increased significantly from an unknown previous year's figure, page 36. However, when comparing specific years, we see a more nuanced picture. The total long-term debt increased by $297 million from 2024 to 2025, $2,429 million, $2,132 million, with a breakdown of fixed-rate and variable-rate debt also provided. A closer look at the data reveals that while there are multiple instances where the company's debt level is reported to have increased, the actual change in debt level is relatively consistent. For example, on page 73, it is stated that long-term debt increased by $375,030 from 2024 to 2025, which aligns with the increase of $297 million mentioned earlier. Regarding interest expenses, there are several instances where an increase is noted. On page 57, total interest expense increased by $19 million, 12.6%, from 2024 to 2025. Additionally, on page 59, it is stated that interest on long-term debt increased by $83.7 million from 2024 to 2025. However, when examining the data more closely, we see that while there are instances of increased interest expenses, they do not appear to be directly correlated with changes in debt levels. For example, on page 81, it is noted that net cash used in financing activities decreased by $107,027 from 2024 to 2025, $-169,653, $-276,680, which suggests a reduction in interest expenses despite the increase in debt level. In conclusion, while there are multiple instances where the company's debt level and interest expenses are reported to have increased, the actual changes are relatively consistent. The data suggests that the company's debt level has increased by approximately $297 million from 2024 to 2025, with a corresponding increase in interest expenses of around $19 million, 12.6%. The company's performance across various segments and regions has been mixed. On the positive side, the shale segment has shown significant improvement with a substantial increase in income before tax, reaching $760,036. The other segment also performed well, generating $59,754 in income before tax. Additionally, the total segment revenue from contracts with external customers saw a notable growth of 54% compared to the previous year. However, some segments have struggled. The coalbed methane segment has been particularly underperforming, recording a loss of $16,849 before tax. Furthermore, the gain on commodity derivative instruments took a significant hit, plummeting by 95% in 2024 compared to the previous year. These results indicate that while certain areas are thriving, others require attention and improvement. Management at CNX is optimistic about the company's future outlook, focusing on responsible resource development and long-term value creation for shareholders. The company aims to drive innovative change through its team's empowerment and strategic decision-making. CNX plans to selectively acquire transportation capacity and optimize its portfolio to take advantage of its strategic location in southwestern Pennsylvania, northern West Virginia, and eastern Ohio. This strategy is expected to generate significant earnings from RMG capture activities in the near term. However, management acknowledges that there are potential risks and uncertainties that could impact the company's business. These include new legislation or regulations, climate change, energy transition matters, global instability, geopolitical conflict, economic downturn, recession, and increased attention to ESG matters. To mitigate these risks, CNX is focusing on increasing operational efficiency and reducing costs through its horizontal drilling and production strategy in unconventional shale formations. The company's future growth depends on identifying optimal strategies for investing capital resources to produce superior rates of return, considering regulatory, policy, and market changes. Management also emphasizes the importance of responsible resource development and long-term value creation, which is reflected in the company's commitment to paying dividends in the future, subject to various factors such as general business conditions, financial results, contractual restrictions, planned investments, and other relevant factors. CNX's acquisitions and divestitures. A strategic overview. In recent years, CNX has been actively engaged in strategic acquisitions and divestitures to optimize its portfolio and enhance shareholder value. On January 27, 2025, the company made a significant acquisition of Apex Energy II, LLC for approximately $518 million, marking one of its most notable deals. This acquisition is part of CNX's broader strategy to expand its operations and increase its presence in the energy sector. The company has also been acquiring ownership or leasehold rights to oil and natural gas properties prior to conducting operations on those properties, demonstrating its commitment to growth through strategic investments. On the other hand, CNX has also been actively divesting non-core assets to focus on high-growth areas. In 2025, the company monetized non-core mineral assets through sales, leases, or contributions to joint ventures, allowing it to redeploy capital towards more promising opportunities. Additionally, CNX sold surface properties by granting rights of way or development rights to third parties, further streamlining its operations. One notable divestiture was the sale of Marcellus Shale rights primarily located in Monroe County, Ohio for $57 million. This transaction not only generated significant revenue, but also enabled CNX to concentrate on more valuable assets. Furthermore, the company repurchased $350 million aggregate principal amount of CNX 7.25% senior notes due March 2027 at a price of 101.9% of their principal amount, $357 million, demonstrating its ability to manage debt and optimize capital structure. Overall, CNX's acquisitions and divestitures reflect its commitment to strategic growth and optimization. By carefully selecting investments and divesting non-core assets, the company is well-positioned to drive long-term success and create value for shareholders. The company has indeed engaged in share buybacks over the past few years. According to the provided summaries, the company has repurchased shares under its stock repurchase program, page 39. The exact number of shares purchased is substantial, with a total of 2,977,594 shares bought back, page 45. The company has utilized various methods to purchase these shares, including open market purchases and privately negotiated transactions, page 58. In fact, the company even repurchased shares as part of a privately negotiated exchange agreement with holders of its convertible senior notes due 2026, page 60. The financial impact of these share buybacks is also significant, with a total cost of $528 million for 16.9 million shares purchased at an average price of $31 per share, page 46. Furthermore, the company's annual reports provide detailed information on its share buyback activities. For instance, in 2025, the company repurchased and retired 16,869,709 shares at an average price of $31 per share for a total cost of $528,073, page 92. Similarly, in 2024 and 2023, the company also engaged in significant share buyback activities, with costs totaling $7,175,674 and $17,564,524 respectively, page 89. In conclusion, based on the provided summaries, it is clear that the company has paid for shares through its share buyback program. There are valid concerns about inventory buildup and supply chain disruption. The company's dependence on third-party pipeline and processing systems makes it vulnerable to disruptions that can limit sales. Disruptions in the supply chain may also arise from various factors such as geopolitical instability, economic downturns, or containment measures for outbreaks. Delays in obtaining necessary services, equipment, and supplies due to weather conditions, inflation, tariffs, and service provider consolidation are potential risks. Furthermore, cybersecurity incidents impacting vendors or service providers could lead to supply chain disruption, adding another layer of complexity to the company's operations. These concerns highlight the need for proactive measures to mitigate these risks and ensure a stable supply chain. That concludes the financial summary for Cnx Resources Corporation. Feel free to comment below, and I will be happy to answer them when possible.